We're going to hear from a lot of the big companies and what are they saying about the economy? We've heard a trickle so far, and it's not been bad. So let's take a look at 5 companies in diverse industries, kind of see what's happening with their chart. I'm also bringing one price to consensus chart this week because I just couldn't resist to kind of show what is happening with some companies being sold off maybe when they shouldn't be. But let's dive right in and see what stocks you should be watching this very busy week. So the first company you should be watching is ServiceNow, ticker NOW. And it doesn't get as much of the play as something like a Microsoft, but maybe it should, because look at that chart. It hasn't missed in 5 years. Super impressive. It did peak in 2021, along with a lot of these other tech stocks. And now it's pulled back pretty significantly here. Year to date, it's down 44%. So I'm sure you're thinking, hey, maybe there's a deal on this, but it still has a ragingly high PE. PE is now about 49 times. So even with the decline, it's not cheap here. But when I saw that, I was wondering what is actually happening with the earnings. And this is the one that I wanted to talk about the price and consensus chart with as well, because here's that chart. And this is the earnings growth projections for the last 5 years, including through 2023. And this is the epitome of what you should have in a price to consensus chart. You have consistent double-digit earnings growth, and it's supposed to continue. So this year, expected to see it up 23%. That's that light blue line there. And then that top line, kind of tan line, is 2023, up another 26%. So will these estimates hold? Right now, they're holding, and we're going into this earnings report. Once they report this earnings, unless something is dramatically changing in the underlying business, it's still looking like 2023 is going to be this bullish. So this is a change. Someone is getting this wrong. Either the street is just, it can't sustain at 50 times, and so they're just selling it off on valuation, or these estimates are going to start to come down as the economy weakens into 2023. We don't know yet, but this is definitely an interesting one and one I keep on my watch list. Then we're going to switch it over to the old industrials, Caterpillar, ticker CAT. This one also has a good earnings surprise track record, but it hasn't missed since the start of the pandemic in 2020. So that's a pretty good, impressive run because you can see some red earlier in this 5-year period, but it's turned that around. But the shares now down about 8% year to date, not too dramatic, not seeing a huge sell-off here, but it is fairly cheap already. It's trading with a forward P of about 15 times. I'd like to see it get a little bit cheaper before I got interested in it, but you do get the dividend here to kind of even out what happens with the stock. You can see earlier in 2018, 2019, kind of doesn't go anywhere. It is more cyclical depending on what's happening in the global economy. And if we do get weakening and recession globally, these shares should come down further. So many of us are on the sidelines, even with that 2.5% dividend yield. And so, but this is one to watch if you want to know what the global outlook on the industrial construction side is looking like. Then we're going to switch it over to one of the hottest names of the last couple of years, Shopify, ticker SHOP. And it has fallen so much here, now down 79% year to date, that when I use the Zacks earnings calendar to look and see who's reporting when, on the day of Shopify, I usually search by market cap just to get the big caps kind of up at the top. And the last couple of years, Shopify has been, in the top 5 on that day that they were reporting. But now the earnings, the market cap has come down so much this year that I have to look all the way down the list now to find Shopify stock way down the list. So that kind of tells you what's going here. It has round tripped back to the pre-pandemic lows and then some. It is coming off those two big misses with the street hated even more. It does not have a PE because it's expected to see negative earnings and you don't get a dividend. So this is your classic growth stock scenario, right? Big time growth, and now it's not. So this is one we're all going to be tuning into, even with the chart looking like this, because at some point it is probably going to turn it around, and maybe they'll give us some clues on if they see that coming soon. But otherwise, Shopify, one of the big losers this year of the growth stocks. Then let's switch it over to Pinterest. Now, this one started falling in 2021. It peaked really early in the year there, and then has been down even with the good earnings surprise track record. So yes, it's coming off a fairly big miss last quarter, but in between there, it's, held its own with some big beats there during the pandemic. A lot of people were on Pinterest and the social media sites during the height of the pandemic, and now they have not. So it's gotten more difficult for these companies to grow the revenue, grow that subscriber base, and that's true of Pinterest. But these shares now down 41% year to date, and over the last 2 years, now down 59%. But are they cheap? Well, not really on a PE basis, still trading at about 40 times because those earnings have come down a bit. So this isn't as cheap as I would like to get it and see it as a value investor, but I'll be tuning in to see what is happening with the advertising side of the business on this. And then we're going to wrap it up with the big old industrial side, again, you might call it, with Exxon Mobil, ticker XOM, but it's having the last laugh this year as it's busting out to 5-year highs and totally doing the opposite of Shopify. These shares are now up 73% year to date, but over this 5-year time period, even with the breakout, up just 27%. That's underperforming the S&P 500, which is up in the 40% range. So it hasn't been a good long-term holding for the longer-term investors, even with that dividend, which is still yielding 3.3%. But could this be the sign that it's entering this new cycle and it's going to be up even further here? We don't know, but the shares are still cheap, trading at 8 times as those earnings remain elevated as we head into 2023. But Exxon, it all depends on what happens with refining margins, with the price of crude and natural gas. They are a big natural gas player, and they're one of the largest chemical companies in the United States. So there's a lot of things going on with Exxon. And right now they're executing. Will they be going forward? I'm going to tune in to find out. So the drilling in my apartment building is a little bit muted here this week. So we got these videos in just in time before the drilling started. But I'm going to be bringing them to you all earnings season long. So I'm a little dubious about what's going to be happening with the construction zone I live in. But hopefully I'll be getting these all in without that drilling noise as we move forward during earnings season. So while this week is one of the big major weeks, and people get kind of bored after this week because we're done with the FANGs and a lot of these big cap tech companies, there's still plenty more that we're going to want to tune into coming up in the next couple of weeks, including the all-important retail sector. So you don't want to miss a single All-Stars video. Be sure to subscribe at Zacks.com/YouTube. Follow me on Twitter to get even more charts and earnings content. It's just at Tracy Reineck. And otherwise, I'll be with you all earnings season. So I'll see you again next week with some more earnings charts.